Hi, everyone. I'm Mark Sir, Product Manager at Saving for College. And on behalf of the whole team here, I'd like to welcome you to today's webinar. As we give everybody an opportunity to join and settle in, I did want to let you all know that we will send out an email, ideally by the end of today, which will include a recording to today's webinar in case you missed anything, as well as a survey in which we'd appreciate any feedback and comments you may have. We'll also have in there a special offer from our presenter, Joe Messenger, and his team at College Aid Pro. So I'll go ahead and turn it over to Joe.
Yeah, thanks, Mark. Thanks for having us. I'm excited to be here with Saving for College. We complement each other pretty well in that, obviously the best way to pay for college is to save for college. But what we're going to talk about today is really how to bridge the gap, going beyond 529 college savings plans and talking through financial aid and hopefully really empower you to give more well-informed advice around the college buying decision. So, we've been at this for quite a while, and we've been very friendly with Saving for College for a long time. So hopefully what we present today is helpful for you. It is eligible for CFP CE credit. So if you did not submit that on the front end and you are a certified financial planner, make sure you get your CFP ID over to the team at Saving for College, and we'll make sure we get that reported by the end of the year. As a CFP myself, I know I still have a few credits to polish off before the end of the year. So again, welcome, and we'll go ahead and get started. So as Mark said at the end, I like to start these sessions by just talking about the fact that when we look at college funding today, I always want to create action out of our webinars. So there's really three things that I would like to see happen. Number one, you see what we're doing at College Aid Pro and you say, man, that's something I'd really like to get on board, and maybe license the software, get into our community, learn about our academy. So that's number one. So if that's where you're at, great. Number two, if you're on here and maybe you're a more seasoned practitioner, you've got a little more of a seasoned practice. If you've got a junior advisor, this college financial aid and this late stage college planning can be a tremendous way for them to add value in your practice and for you to level up the game that you have in this very specific area. We know advisors are busy, so this is one more thing. We don't want it to be one more thing. We want it to make it easy. So delivering this with confidence and ease. So if it's you or someone on your team that can learn this, they can be the surgeon in this area. And then number three, if you want to talk to us about outsourcing this work, making sure you've got great advice and guidance for your clients, we've got college experts on staff too. So we understand that sometimes, just like we refer out legal work or tax work, maybe that's the way you are going to choose to approach college funding as well. So we'll dig in today. And I like to start with this, and that is talking about where we're at in college funding and what kind of the industry line has been for years is that there's lots of ways to pay for college and only one way to pay for retirement. So we've grossly ignored really the college buying decision, helping people make a guided decision here. And that's a problem because the narrative at home is very different. And that is, honey, if you get in, we'll figure it out, right? All too often with college, we're accounting for the past instead of planning for the future. Right. So what we're going to show you today is how College Aid Pro is a college crystal ball. What I mean by that is we can help you see into the future. If you go here, here's the 23-year-old you, right? So this is an actual person that I have met, and I use this example a lot. This is a woman I met at a financial planning conference a couple of years back. And she said, I'm really looking forward to your session. And I said, oh, that's great. Tell me, what's your college story? Well, I went to a great private school, played lacrosse, had a great experience, but turns out woke up and figuring it out for Sam and her parents. Well, that meant she took out $128,000 of student loans, most of those co-signed by her parents. So the plot thickens with these kind of stories is that she's been making successful payments for over 7 years, and she hasn't even been able to pay the interest. Right, her balance is higher than it was. 120,000 is now 129,000. So this is not a great college outcome, right? The plot thickens even further. This is a woman who told me she has not talked to her parents in over 3 years because this financial strain for her is something she feels like she will never get out of. And she blames her parents because they didn't help her make an informed college buying decision. I'm 16, 17 years old. How the heck was I supposed to go into this? I'm going up against higher education, the federal government that gives most of the loans, right? And Wall Street that's giving me the rest of the loans, right? So us as advisors, if we can be that advocate, that's what we're talking about here today. How do we create a system where you can give great advice with confidence and ease? So hopefully that's what you get out of today. College Aid Pro, it's about changing the way that we shop for college in this country. It's about raising the bar in college funding advice. So I'm going to talk about what exactly we mean by that. And we know to do that, you need to be empowered. You need the right training, you need the right support, but you also need software with great deliverables so you can have a meaningful conversation. The financial planning industry has turned into, we've got to raise the bar. Our value proposition has to be increased, across the board, because we've basically been told that our money management is worth about 25 basis points. So if you're charging 1%, what are we doing for the other 75 basis points? Okay, so all these things collectively together, we can end the student debt crisis. We're making more informed college buying decisions. We're doing it the right way. This is kind of the wireframe of what we want to go through today. I want to walk you through, because I think it's important to understand what is the opportunity, why you should really consider giving more advice in this area. And what do we exactly mean by raising the bar? And then we're going to talk about our 5-part framework to deliver great college planning advice and do that in a repeatable and scalable way. I think that's really important with anything we do in our practice today. If we're going to do it once, we should be able to do it 100 times. So to do that, anything we do in a repeatable, scalable way, extremely important, right? So College Aid Pro, yes, we're a software provider, but we're actually just a technology partner. We've got workflows we help with. We help people install things into CRMs, like all those kind of things. Our technology integrates with different technologies. So how to create a real framework around this so you can deliver great advice, but do it in a repeatable, scalable way. We'll talk about the tools that are out there, and then we'll talk a little bit about how advisors are integrating late stage college planning into their practice. Where does it fit? How does it come into the game, into what we're doing? So if you want this ebook, you can go to the collegeaidpro.com/blueprint. It kind of goes through these in detail, but we'll hit the hi-hats here today. We're on with Saving for College. So 529 plans, the predominant college savings tool. I love 529s. I think they're fantastic. We've seen tremendous growth in what they're doing. Over the last 10 to 15 years, the average account balance has nearly tripled, which is awesome. And the total dollars inside of 529 plans since 2009, you can see that, it's nearly quadrupled, which is awesome. Right. So, but the reality is at $30,000, that pays for 1 year at state school these days. So our advice and our guidance needs to go beyond 529 college savings plans. So we have heightened the awareness of the need to save, and 529s have become the right vehicle to do that, which is fantastic. But we are in the first generation right now of families that they're paying off their own college student loan debt well into their kids' teen years. So think about that. We're in the first generation because of student loans. It's starting to really hit home where people are paying off their own student loans to their kids are 8, 9, 10, 11, 12 years old, right? Especially highly educated folks. So the runway to save is shrunk. So we need to just help understand, where do the 529s pick up, or pick up, leave off rather, and where does really good college funding advice pick up? So that's where we handle this. So it's not just 529s, it's not just student loans. How do we make this great college buying decision? Save as much as you can, but how do we go beyond that? And then also as part of that is, how do you decumulate, right? 529 plans have been around 30 years, which is awesome. And we finally have some mainstream, people know what they are, hopefully, but less than 17% of parents actually have a 529. So, we need to continue to amplify the need for 529 in college savings, but at the same time, understand we are now getting in the first real phase where a lot of money is coming out of 529s. How do we do that efficiently, effectively? How do we balance that out? How do we create a 4-year college funding plan that includes a 529, but also what other resources are on the table? And as I said, the college prices are not going down. I've been doing this for, over a decade, working specifically with financial planning for college-bound families. And from day one, this is untenable. There's no way, et cetera, et cetera. I actually looked at an old presentation from 2012 the other day, and the high-end Ivy Leagues, 45,000. 2012, 45,000. That was our elite schools. The prices have not gone down. They continue to go up. The good news is there is some leveling. The trends are that they're not going up at 5, 6, 7, 8% per year, but they are still going up 2 and 3%. So there has been a leveling. And the other thing I'll say there is, when it's 3% on $80,000, that's a meaningful number, right? So we're going to see schools over $90,000 going into next year. So if you look at this investment in education, this is $100,000 to over $300,000 investment. $100,000 to $300,000 per student. So what I would say is, if you're a fiduciary, what other investment of that magnitude are you not knowledgeable on and give great advice around? And think about that. $100,000 to $300,000. You got 3 kids. We're talking upwards of $1 million. So hopefully that's why you're here. You want to help understand how all these puzzle pieces fit together. We can't get into this without talking about the student loan piece. Talk about 529s. Let's talk about student loans now. The scary stuff that I see is that not only has the balance gone up, because the 1.7 trillion, that'll be 1.8 trillion before we know it. That's just it's just rolling off the tongue now. Like, it's no big deal. There's so many zeros behind that like people don't even conceptualize how much money that is. What they don't know is the federal government, it's nearly half of their assets is the ability to collect on these student loans from Americans. I'll say that again. Nearly half of the United States assets are their ability to collect on these student loans. So do they want to forgive student loans? Maybe. So when we talk about loan forgiveness, to me, and forgiving a huge batch of $500 billion student loans, that's not the solution. It puts a Band-Aid on it and creates an expectation that I'm just going to take out as much student loans as I want because it's just going to get forgiven anyway. That's not what I want. I paid off my own student loans. I made a consumer choice. I chose not to go to the elite private school. I chose to go to a school that we thought was affordable. That's where we need to get. So, creating the expectation. So, we've over, we'll quadruple our student loan debt, but more importantly, we've over doubled the amount of borrowers out there. 45 million American borrowers out there. So if you're watching a football game this weekend, you look in those stands, 1 out of every 6 people in those stands has a student loan. Think about that. That's crazy. Think about that. Picture a football stadium. 1 in every 5, 6 people out there has a student loan. The fastest growing group of student loan borrowers over the age of 50. It's because of graduate plus loans. And it's also because of parent plus loans. It's growing fast. So this is everything that's going on. The statistics are there, but the reality is, for most parents, they say, we don't want our kids to have student loans. Okay, that's great. We can help you find that affordable path. Make sure they don't have any student loans, but understand, for the majority of students, student loans are just part of the equation. So we talk about college funding, we talk about financial aid. You got to understand, we want to help parents understand, I'm not anti-loan, I'm anti-too much loan, right? We want to end the student debt crisis. It doesn't say that, debt's not part of this. When you're making a great investment, should be a good investment. Hopefully we're just making a good, solid investment in education. So a couple rules of thumb that I like to throw out. One is, for every $10,000 you take out in student loans, you're going to owe back roughly $100 per month on the standard 10-year repayment schedule. So for every $10,000 you take out, you're going to owe back roughly $100 per month on the standard 10-year repayment schedule. So, and that's important because not all majors are created equal, right? Your ability to repay that loan is directly related to the income you make, right? So that's, just things to think about and consider. So, if you come out of school making $30,000 and you had an $80,000 loan, what's your net pay? Your take-home pay is 2/3 of your student loans, or 2/3 of your paycheck. The math doesn't work. That's where people get into trouble. So again, we're going to hopefully avoid getting in over our heads with student loans by having a process and a framework. When we talk about what's going on for the financial services industry and for the consumer, right? We talk about the need to differentiate, the need to offer something unique. When people we hear from advisors all the time, and I think there's probably in some of our promo material, when they see what College Aid Pro does, what we hear all the time is, we didn't know a service like this existed. Think about that. In 2021, in financial services, we didn't know a service like that existed. I hear it from CPAs, attorneys we share it with, and the consumers themselves. Because on the left side there, what you'll see is, 75% of parents nearly, they say, our number one concern is how to pay for college. And it's by a mile. If they have school-age kids, their number one concern is how to pay for college. Not how to save for it, how to pay for college, right? Because why? Because they want what's best. They want their kids to have a great life, right? That's why we go to college, because it still have that ability to help you have a great life. So on the other side of the fence, advisors every year continue to say our number one concern and our number one priority is getting great new clients, and it's also our biggest challenge. So you've got a group of consumers saying, we want help with this specific need that's very acute. I'm having a heart attack. We've got advisors that typically say we don't do that. For me, what that's meant is an opportunity. For me, I'd say like I have 100 million reasons why you might want to consider this, because we built a firm on AUM model for $100 million in assets in about 6 years. So that's the opportunity that exists for advisors to get out there, because this layers on when you look at the bottom left. Students that are in college repaying the student loans is the number one concern. Guess whose concern that becomes? The parents, because they either end up in the basement or they're begging them for money because they can't pay their bills, right? So all this comes down to advisors are never really trained on how all this works. So hopefully we'll unpack that today. Even the highest credentials, we're never really trained on it. So hopefully we'll unpack this today, give you a framework to deliver great advice. The landscape that's out there, every year we've got about 4 million kids that graduate high school. So that means that every year there's about 4 million kids that enter the freshman year. So I look at this and I say, this is a constantly renewing market of people that need help. They need help navigating this college funding maze. Right now, those that are most concerned about this, it's right square on Gen X. It's those that are 40 to 55 years old, right? 40 to 55 years old, that's who this is squarely dialed in on. And I can tell you that the folks that can just write the check, 1%ers. Right? The folks that are going to get a good chunk of financial aid, they're going to get need-based financial aid as long as they fill out the forms. The people that really need help are middle and upper middle class families. Families making $150,000, $250,000, $300,000. They're on the bubble. That's the Gen Xers that really need help, because as you'll see in the financial aid forms, or what we'll talk about, they get left behind. They don't get a lot of need-based financial aid, but they also don't have the money to write the check. So they're kind of left holding the bag. So helping them make more informed college buying decisions, understanding where to get the most free money, that's what we're going to get to today, so that you can help them navigate that process. This is a constantly renewing market, right? That's the opportunity that exists, because every single year it's wash, rinse, repeat, wash, rinse, repeat. There's always new people, and the demand for a college education hasn't gone down. 7 out of 10 people go right on to college, especially in middle and upper middle class high schools across the country. It's not for me to say that that's right or wrong. I know there's great pathways to do other things. I believe tremendously in those other areas to go get higher education, but do it in an applied area. Huge proponent of that. But the reality is most families look at a traditional 4-year path to college, especially in middle and upper middle income communities. So the other piece I'll say here is a lot of people these days are still out looking for the baby boomer. Right? They're looking for the 63-year-old. She just sold her business. She has a liquidity event, and now we need to help her. The sudden money she's got, we need to help her out. I say, I'm looking for her too. I just want to find her when she's 50. Right? So building that relationship over time, what happens is what the industry is telling us too, Cerulli & Associates has done a lot of work on this to understand the great wealth transfer is coming. Baby boomers right now, most, they are the group. They hold most of the money. But over the next 25 years, 70 trillion of that's going to pass down to the next generation. And that's Gen X and that's Gen Y. So a couple of things to understand there is if you build a firm and you're working with a little younger clientele, you're going to inherit that money. You're going to get those rollovers when they move into retirement because you've earned that trust. If you get college right, you will get the rest of the business. It's not because we were firm believers in you shouldn't look at college in a vacuum. You need to look at it in terms of an overall financial plan. And the other piece of this, as we understand, is firms that have an aging clientele, if you're not bringing in new blood, guess what? I've seen as high as 8 out of 10 people are firing their parents' advisors. So you have an opportunity, if you've got an older clientele, to reach down and connect with the next generation of investor. Help them figure out how to pay for college for their grandkids. Reach down, have that conversation. It's much more meaningful than saying, I want to manage the money when your mom and dad die. I want to help make sure that your grandkids have a great college experience. And we've got new solutions to help do that. Now you're really creating that tri-generational. You're getting the boomer, you're getting X, you're getting the Gen Z. So hopefully that's helpful to tee everything up, because then it gets into how do we deliver this advice? How do we do this in a repeatable way? And that's where, I say it took me 20 years in the business to come up with five critical things. But for me, what we do in financial planning and how we deliver it, it's about making it actionable, and it's about making it bite-size, right? We deal with a lot of complex matter. It's the end of the year, right? So you're in a planning firm. If you're doing great planning for clients, what are we doing right now? Well, we're doing, should we be making a gift? Do we have capital gains and loss harvesting we need to be doing? Do we need to be funding SEP IRAs? All these things we need to do throughout the year. We need to create this in a repeatable way, right? So this is the time of year, but like with college, I've really worked hard to create a framework that we can run on. So this is the 5 pieces we'll go through and spend some time on. It's how much colleges think you can afford. That's the expected family contribution. So that is how much colleges think you can afford. That really drives the front part of the financial aid process. Number 2, how much can your family actually afford? Our belief is that college should be pre-approved just like a mortgage, right? So that is college pre-approval. So college pre-approval, if every family would be pre-approved for college like they did for any other major purchase, we wouldn't have the problems we have today with student loans. Number 3, how do we find schools that are going to be the most generous for us, for our family? Every student and every family that goes through this is a snowflake. We'll talk about that. The how to find schools that are generous for you. Because listening to your cousin or your aunt or your uncle that says, we got a full ride to Princeton, well, I can tell you that full ride means that family's poor, because Princeton doesn't have scholarships. So they only award based on need-based financial aid. There's nothing against that family. And it's also nothing against you. But if you're a high income family and you get into Princeton and they expect you to be able to pay, you're going to pay. They don't have scholarships. Doesn't matter if you're valedictorian, 36 ACT, you launched a space rocket when you were 13 years old. Doesn't matter. So we'll help understand what do we mean by how do we find these schools and understand the business model of the schools. That's a really important piece for financial advisors to understand, I think, is that these are businesses, but they run their businesses fundamentally differently. So we'll run through that, give you some concrete examples to take back to your practice. Number 4, how do we understand the out-of-pocket cost? The sticker price of college has become irrelevant. $85,000, $70,000, doesn't matter. What are we going to pay? That's what we need to know, right? So the other part of that, out-of-pocket, traditional financial planning software, it only shows us the sticker price of college. So that's not an informed conversation either. Our great financial planning software, which are our partners at College Aid Pro, going beyond the sticker price to understand what are we actually going to pay out of pocket here. So we'll talk about that. And then the last piece is, what's the result? We're in this for an outcome. Why do we go to college in the first place? Right? You go to college to get a job that you couldn't get without the training you got while you're in college. Right? That's why we invest in education, to go get, to have opportunities we wouldn't have otherwise. Right? And that it doesn't matter if it's liberal arts or otherwise, like you're getting educated and you're becoming a more well-rounded person. If that's specific in business or if you're getting liberal arts, it doesn't matter. What matters is you're getting higher education. You're becoming more intelligent human. So, but at the end of the day, it still comes down to what's our gap, what's our resulting loans, and what's our loan payment. The loan payment's where it hits home, right? So that's the key. So let's dig into these pieces. So number 1, I talked about the sticker price of college is irrelevant, right? So this is merit scholarships pay for about a third, and grants. So free money from colleges pay for about a third. About a third of the cost is paid from free money from the schools themselves that are out there. And the most recent statistics are that private colleges that are charging $50,000, $60,000, $70,000, they're discounting their tuition over 50%. Most recent I saw was up to 54% on average. So that means some schools are discounting 60%, 65% of their tuition. It's become this game of if you increase your price, you're a better college, right? I mean, the price saliency is just not there. So they say, well, yeah, I know we cost $75,000, but nobody pays that. Well, why are you charging it then? So it's become this shell game really to help attract and acquire. But if you're 75,000, I'm going to be 76. If you're 76, I'm going to be 78. That's a problem. But like I said, keep that in your mind. Sticker price of college is irrelevant. And the averages are often misleading. When we talk about financial aid and how it's done, it's about the business model of that university. The business model of that university is going to dictate what type of financial aid you get, be that merit scholarships or need-based. And I say the averages are misleading because if you go to a tour at a private university or a top university in the country, and you've got the student walking backwards talking about, the president, 4th president lived here, and the CEO of this company lived here, and all the great things about the university and all the great features and all stuff. Like I'm not picking on Georgetown, but they go and they say we cost $79,000 a year. Oh, but nobody pays that. 53% of our freshmen get financial aid. Cool, that sounds pretty good. If you have financial need, we meet 100%. That's also great. But what if I don't have financial need? What's that mean for me? We don't have scholarships. 0. That's percent to get a merit scholarship for undergrad. Nothing against you. You're valedictorian, perfect ACT, but that's just what's going to happen. But what the consumer walks away with is the average net price somebody pays here is just over $28,000 a year. So you're going, oh, cool. So if that's average, maybe we pay a little bit more, but that's the average. These averages are misleading. It's all about what are you going to pay? How do we create a highly tailored approach to this? And that's what we'll get into as we keep going. On the same token, I got to say, for advisors that are out there that really do a lot of work in their community, this college piece for students of low income, it is disproportionately affecting them. The estimates are that only about 35% of kids from low income households even fill out the financial aid forms. And we need to change that, because schools like Georgetown and some of our top universities out there, if you have need, they will pay for it, right? You got to get in, you got to do work to get in. But with this piece, Georgetown happens to be the example. For this past fall, we had a valedictorian student from an inner city school in Columbus, Ohio, that was looking only at the state schools and some of the community colleges. We said, well, what's the dream school? I said, well, Georgetown. I said, well, if we could make that happen, it'd be great. So come to turn out, just because of the way they do financial aid, this student's going to Georgetown for half the price of our state school. And that's just because of the way they do financial aid, whereas a high income family had to pay full price. So again, it's all about you. The averages are very misleading. So how much schools think you can afford? We have a much, there's a lot to unpack here through the financial aid forms. So I'm going to spend a chunk of time on the basics. Understand there's a much deeper dive in some of our trainings, and we'll spend more time. We're going to do some future sessions, deep dives into EFCs, but I wanted to at least give a high level because it does drive the conversation. So the FAFSA is the free application for federal student aid. Hopefully that's not new to you if you've been in the business a while. But the key is the timing, and what does it mean? It drives the federal formula, and that's going to determine how much a school thinks you can afford that uses that formula. So the timeline is key with this. So I'm already past seniors, so I'm thinking now about our junior class, right? So if you're a junior right now, you're a rising senior going into the spring, but you're a junior in high school right now, you're going to graduate. In 2023, right? 2022 is just around the corner. We're going to graduate in 2023 and head out to school that fall. So next October is when your financial aid applications become available. Before that, your applications for admissions become open around August 1st. Applications for financial aid become available October 1st. You'll see some of the things we have here. So what are we looking at here? So the FAFSA becomes available October of the senior year, and we recommend you get it filed by November 1st. Now, why is that? Why is the timing important? With financial aid, put yourself in the school's shoes. You're telling them, if you have money, we would like it. So we're going to get in line first, right? And that's not just for need-based financial aid. Oftentimes, that's also to qualify for merit scholarship. So people ask all the time, well, if I'm not going to get financial aid, why would I bother filling out the financial aid forms? Why would I bother with the FAFSA? Well, there's a couple reasons. Number one, you fill this out. It qualifies you for any federal aid that may be available, and that includes the federal direct student loans in the student's name, which we'll get to if we have time today. So that's thing number one you might want to consider. Number two, circumstances change. Even if you didn't get financial aid, if something happens mid-year, you're going to make sure that's on file with the school. Why? Quite honestly, people have passed away midstream. If we had not filed the financial aid form, we would have had a lot of trouble going back to them asking for some money and telling them about the change in our situation. But because we filed the financial aid form, we actually got about $5,000 more for a semester and $8,000 more for the next semester. Because we filed the forms, they had something on file. So that's an important one. And then this merit scholarship. A lot of schools, even if you don't qualify for need-based financial aid, if you want to be considered for merit scholarship money, you still need to fill out the financial aid forms. So that's a school-by-school thing, but it's something that's often overlooked by people, and they say, well, we're not going to fill it out. We're not going to get financial aid. I'm like, well, you might want to make sure that also means scholarships, because many schools, they still require it, because you're telling them, if you have money, that free money, we would like it. That's how they kind of think about that. So don't necessarily just say, oh, we're not going to bother filling out the forms. That's a common mistake I see by advisors and people that have come into our office that said, my financial advisor said not to worry about filling out the form. And they said, well, do you think you might need loans? Yeah, probably. Well, they were wrong. They're wrong. If you need them, federal direct loans are the best ones out there. We'll go through some of those. So those are some of the reasons you make sure you fill out your financial aid forms for basically 99% of people. And this is a process. You fill out the FAFSA each year. Things can change, but for the most part, when you look at this process, the freshman year is the most important year. The freshman year is the year that you want to look as poor as possible. And why is that? Because there's an enrollment manager at this school that's saying, how do we get in a diverse class of students? They're out there trying to make sure they get, they really are the low, middle, and high income students. We need some full pay people. We need some people that are going to get grants. They want to create diversity, from a socioeconomic standpoint, but also diversity from, all other areas, right? So they have mandates around that: international students, in-state students, out-of-state students. But part of it too is they're trying to figure out what's our average student going to pay here this year, right? So they have a big job to do, especially if you're University of Texas. You got 50,000 kids coming next year. 10, 15,000 kids per class. So it's such a big number. It's a lot to manage. But when you look at that, thinking about if we want to get in line as soon as possible, the deadlines become important, and what they're looking at becomes important. Your freshman year look as poor as possible, because one of their jobs is to package for 4 years. They want to know what's going to cost them and what it's going to cost you for the cost of education. That's what they're trying to figure out. So your freshman year, you want to look at it because you're going to, your best opportunity to get the most aid, either from need-based and from merit, is that freshman year. So you want to look as poor as possible. So those are the years that, if there's things you can do to, have less income, have less assets, it's what you want to do. So here, this is the basics. So the basics, what they're looking at, the assets are pretty simple. It's as of the day you file, right? So when you click that button and click submit, that's your balance sheet as of the day you file. So this here basically shows what they're looking at from an asset standpoint. They're looking at the parents' assets as low as 2.4, as high as 5.64%. Anything in non-retirement, they want 5.64% of that. And then students, they want 20%. So this asset allowance that it used to be meaningful, but it's basically, I don't even know why they still have it. If you're a 45 years old married couple now, it's like $4,000. So it's basically irrelevant. So just think general terms, anything in non-retirement for my parents, for the parent, 5%, anything non-retirement for the kids, 20%. So first rule there, obviously, and it's always better to have it in the parent's name than the student's name, right? So that's thing number one. Parent's name and the student's name, and then what are they looking at? So on the left side, it's basically all non-retirement. You tally all those up, and that's your total assessable assets. So a couple things to pick off on here, and then on the right, obviously, anything retirement related is not included on the forms. One of the most common mistakes, people put their entire retirement accounts in there. So on the left side here, they're going to look at cash, and 529 is for all children. So 529 plans often misreported in two ways. Number one, they only report the 529 for that student. So if you've got 3 kids, 25,000 each, the number that goes on the form is 75,000, because you own those and they know that you can change the beneficiary as a parent. So the number by the letter of the law that goes on is 75,000, right? So not 25. The other there is people, I see it every single year, put the 529 as a student asset. 529 is a student asset, and that's a problem because it's assessed at four times the rate, right? So just by putting it in the wrong bucket on the form, you're costing yourselves potentially thousands in financial aid. So these little things are the reason you need to help your clients fill out their forms. Help them figure it out, because even if you're not doing the level of nerddom that I do when we talk about college planning, just helping them get the financial aid forms filled out properly, getting things in the right bucket because you understand all these terms, can be hugely beneficial, and you're just adding value for the client, right? So on the left, anything mutual funds, stocks, bonds, after tax stuff, and then equity in rental real estate, equity in vacation properties, right? So I'll talk about that in a minute when we talk about home equity, because you'll see on non-assessable, we're on the FAFSA right now. Home equity is not assessed on the FAFSA, right? Nor is your small business unless you have over 100 employees. When we look at the other formulas that out there, they often will get those pulled in. The other piece we get questions on all the time, well, what about putting dollars into annuities and cash value life insurance? Are they not assessable? It is accurate that they're not assessable. But when you're in the late stage college planning area, what I can tell you is the vast majority of the EFC is produced from the income, not the assets. The most they're going to assess an asset is at 5%. So repositioning things, can it help? Yes. Is it a planning technique there? Yes. But you really have to weigh out, is it worth the dollars that go into it? Because I'd be hard pressed to find an insurance policy that costs less than 5%. So think about that before you make those kind of things. And then also annuities are being assessed by some schools out there. So that's another piece to be aware of. So they have their place, but I'm here to tell you, like ours is about giving great advice. It's not about repositioning assets. Ours is about giving great advice around college funding, where to get the most free money, because most of our clients that make great clients don't qualify for financial aid anyway. So, can it help? Yes, but that's just not us. So be very careful and cautious about that being the only strategy people have. So that's kind of it on assets. And then on income, what they're looking at is the prior tax year. So if you're going off to school the fall of 2023, 2021 is the school year, or is the tax year that they're looking at. So it brings up a point of the parallels and then the differences of financial aid and tax. A lot of the same terms used, but the way they apply are very different, right? So a lot of the same stuff. So when we talk about income, they're looking at the prior tax year. So this tax year, it's the spring of the sophomore year and the fall of the junior year of high school. So I'll say that one again. The spring of the sophomore year and the fall of the junior year of high school, that's the tax year they're looking at to assess your ability to pay for college 2 years later. So right now is the opportunity. So the need for college planning has actually become, you need to do it sooner. Freshman and sophomore year. If we're going to make any impact, or we want to potentially work with a business owner to, shift income, or we want to make sure have them accelerate expenses a certain year to be as poor as possible, this is the year it really needs to happen, because this is the base year they're going to base your 4-year package on. So hopefully that's helpful to understand that this is the tax year. If we're going to plan for it, we need to start having these conversations when we have 8th graders, 9th graders, 10th graders. So it's not when you're a senior. So that's income in a nutshell. And what they look at is they give you they take out taxes. They give you a small living allowance. I think it's around $18,000 for a family of 4. And then from there, it's 22% up to as high as 47 cents on every dollar for the parent. 22 cents up to 47 cents on every dollar that you have, right? So families making over about 110, 120 for families, for married families, they want 47 cents of every dollar. So it's kind of like how Social Security ramps up. So too does the parent income assessment rate. So when we look at that, we broke this out. And I just said, can we just dial in on just the income? And we said, yes. So here we go. If you've got 2 kids, you make 150,000, they think you can afford 31,933. That's what they think you can afford out of income next year for college. So you see these go up. People always ask, like, well, when should we not bother? I used to say 250, but quite honestly, as you'll see, schools now cost $85,000 and $90,000. So even at that level, you'd still qualify for some need-based financial aid at some schools. So it really is very circumstantial in understanding it's not a one-size-fits-all. So I do see a couple questions, which I'll hit on. If you can put them in the Q&A, it's easy for me to manage. And I do have a break for questions here in a minute. So I like to say this because the plot thickens. We've got the FAFSA that's a majority of schools, and we have a number of schools that also require that use an institutional formula, and they use a CSS profile as an additional form. It's an and, not an or. It's an additional form required by some of our elite privates. 250 to 300 schools. It is a little bit fluid, but for the most part, it's administered by the collegeboard.org. And there's a lot of differences, but there's one of the groups is also what's called the President's Group. They use a consensus methodology. This is 26 schools. I think it's 25 now, actually. But this is another group that does things even a little bit differently. So on this, the 568 President's Group, they've said, look, this thing called need blind right here. What does that mean? Well, that means that we're not going to use the family's financials to determine if the student gets in or not. We're not going to use the financials to determine if the student gets in. It has nothing to do with financial aid. So that's an interesting one, because there are absolutely schools out there that if you can demonstrate you can pay full price, you'll have a much better shot at getting in. It will give you a leg up. And then need-based aid over here on the left, what they're trying to say is like, look, we're not going to provide, everybody that gets in here is really bright. There's some of the top schools in the country, but we don't have scholarships. We provide based on need. And we're going to use a similar formula to figure out what that looks like. The differences, okay? Many of these, if you have a small business, they're only assessed on the FAFSA if you got 100 plus employees. Profile and consensus will look at the value of your business. I could do a whole session on the business valuation. But the big ones we see almost all the time are home equity. So how do they look at home equity? Well, FAFSA doesn't look at it at all. Profile and consensus schools, can vary wildly. And I'll show you in the software what that means too. And then assets in a student's name, pretty flat across the board, but consensus schools, they want 5% of anybody's assets. So if you've got somebody with a $100,000 trust account, and we've had this happen, the difference between a profile school, they want $25,000 next year. This school wants $5,000. Just their business model, just how they look at things. So imagine that, being able to demonstrate, say, maybe we should look at some of these schools that are only going to look at that asset at 5% as opposed to 25. That's $80,000 swing in 4 years. So that's the level of value you can provide real quick. And then non-custodial parents. The FAFSA only looks at the parent that provides the most support. There's some changes coming there, by the way. CSS profile, it varies. So most schools are going to look at both the custodial parent that they live with and provide the support, as well as the other parent, the other birth parent. So and it varies. But in the consensus schools, yes, they're going to pull it in. So if I'm divorced and my ex-spouse is a surgeon making $400,000 a year and I make $60,000, I might want to go look for schools that are only going to look at my income and make sure that my student lives with me the majority of the time. Right. So those are the kind of things you get into with planning that can become very important. And there's a lot of nuance to it. So example of home equity. So the way that most schools kind of look at this very differently. They're either going to say, like the bottom here, we don't look at it at all. So that's great. But some schools say, if you have $500,000, we're going to assess that as an asset for school, and we own 5% of it, $25,000. So that's a big difference. And a school that says we don't want any of it, we're not going to assess it, versus those that say I want all of it. So if you're a family on the coast and you're in San Francisco or New York or Boston, you might have a home worth $1 million with $500,000, $600,000, $700,000 of home equity. They think you're rich. You're just squeaking by in those communities. That means you bought at the right time. Doesn't mean you're wealthy. So understand, like, it's just their business model. It's nothing against you, but if you know that and you can provide that level of precision and guidance to your clients, you can have your fees become irrelevant real quick. You can show them schools, and we'll get into some concrete examples of that here in a second. So if you have the EFCs of the school, the very different ones in a divorce situation, obviously, now we know what they think we can afford. Now we can go shopping intelligently if we have, now we create our budget. So I'll take a couple of quick questions, checking my time. Should be okay. Yeah. So yeah, these are some questions. Northwestern absolutely counts it. So the question that came in, so we'll hit on that actually in the software to show you schools that do and don't hit home equity. Is this doubled or so? Essentially at 12%. 5.64 is just the assessment rate. So it's actually 12% times 0.47 gets you to 5.64. As you go down, if you look at the FAFSA form, it's actually 12%, and then you multiply that times 0.47 to get you to 5.64. That's a super nerd thing I'll run through when we do our line by line FAFSA. So great question though. Yeah, it's not important. Yeah, so similar question. Northwestern requires a CSS profile, and that's where the home equity is asked for. All right, so some of these other ones, just a question from Russell on why is the 529 is only counted as 5%? Because it's considered a parental asset. It's considered a parent asset, so 5.64 max on the parental asset. It's not an asset of the student. The parent owns it, and even at the FAFSA, even if the student owns it, it's actually supposed to be reported as a parent asset. So it's an interesting little piece there too. And we can go through all of the nuances, in another session on 529s. We can spend a lot of time on that piece alone. So I'm trying to keep high level today, and then we're going to do some drill down sessions throughout next year. Student aid index stuff, there is major changes coming. I'll hit on that in a second, but I'm not going to drill too deep into it today. Student aid index isn't really going to take effect until 24-25. So this is a new way that they're going to be looking at it. It was originally slated for 23, and they've pushed it back. So a lot of changes. There's a lot of proposed right now, as I would say. All right, I'm going to keep going. I'm happy to stick around for questions as long as we need, but I want to make sure we get through the content. The next step in the process, if you know what they can afford, you need to understand what your family can actually afford. So this is an example of, like, if I go into a bank and I ask for a loan for this particular house, they're going to laugh at me and tell me to get out of there. And they're not going to pre-approve me for that because that's Jay-Z and Beyonce's house outside the Hamptons. So I don't have the resources. I have no business being in that house. With kids, what we're telling them to do is go get great grades, get perfect ACT scores, and then we're going to go shop for schools with basically no budget in mind. We're just going to go and hit the greatest hits: Vanderbilt, Georgetown, Penn, up and down the coast. We can go up to MIT, hit Harvard. But if you're not a need-based financial aid candidate and you have no idea what that school is actually going to cost you, so we think it's important to actually figure out what your budget is. So I'm going to pop out and actually go into the software application to go through the pre-approval exercise. So this is a first look inside of College Aid Pro. It's an advisor workstation that guides a family all the way through the process. So we've got their EFCs we've already produced up here, and we've got the different steps of the process. Facts are going to produce the EFC. The budget exercise is very different, right? So when we talk about, the facts, we're going to collect all these things: student bio, income, and assets. That's going to project your EFC as well as your scholarships, but the budget is a totally separate exercise. So I want to know, for Al, what do we have set aside for college for him? So 25,000 is the balance. 200 is what we save. We're going out to school in about 12 months. So we've got some 529s, which are great. Do we have any other assets set aside, that aren't 529s? That's a good one. And then cash flow is an important piece of this too. Most families have very good cash flow for college. Because they paid off their own loans and they're in their peak earning years. So as we get to this point, this cash flow exercise is very helpful and important, because in this process, it's like you got to show them that, like, there are normal families paying for college, but they're not doing it all with savings. 529s are great. And hopefully if you're on here, it's because you've worked with Saving for College and you've gotten them to a point where they've got a balance there. But how are we going to work through college? And we say, like, well, what are you currently saving? We said they're doing $200 a month. Great, let's start there. Well, what about a meal plan? They're not free to feed while they're at home. So an average meal plan at a school is $2,500 to $3,000. So let's just put that in. So let's just start there without even changing your lifestyle. That's $400 a month, right? So it's almost $20,000 over 4 years. These are the kind of things that just help visualize for parents and say, yeah, we could probably do another $100 a month. Okay, cool. That's 24,000 we have now. Will you qualify for the American Opportunity Tax Credit? For another topic for another day a little bit, but this family would, based on income. Are there any student assets? Do you expect the student to work while they're in school? Is that going to go to actually pay the bill? Because that can move the needle. If you're saying it's $200 a month or just, $2,400 per year, that's $10,000 less in student loans. That's $100 less in payment when you're done. And then this is a big one too: grandparent outside help. It's fascinating to me that I meet with successful 52-year-old families and they make a couple $100,000 a year. They still can't talk to mom and dad about money. Our job is to help hopefully bridge that gap. So you can either reach up and talk to a grandparent about what they have, quantify it and qualify it, or you can reach down if you have the grandparent asset and you can say, let's talk about college funding for the kids. It's all about a great outcome for Al in this case, right? So if we say, yeah, they said they've got $20,000, great. So now we've got a budget. We know that we've got around $25,000 a year. So that's an important piece, because now we know what they think we can afford. We know what we can actually afford. These different formulas are looking at us very differently, right? How much they think we can afford. So now, I'd say we're like cooking with gas. Before we go into school search, I'll hit on a few other points. Because once we have a budget, now we can go shop smart, and it's all about finding schools to be the most generous with financial aid for our family. Because financial aid comes in two forms. There's merit-based aid and there's need-based aid. Merit-based aid, it's gift aid. It's scholarships that you earn based on unique skills. And the need-based aid is a little more complex. It comes in scholarships, grants, but it also comes in student loans and work study. Loans and work study do not reduce the cost of college, although they will be presented as if they do. The financial aid award letters are extremely confusing, and they're going to present student loans and work study as if it's cutting your cost of college. It is not. So help clients cut through the noise and get down to what they're actually going to pay. From a need-based standpoint, they're going to look at the cost of the school minus your EFC equals your need, right? So my example here, if it's $50,000, your EFC is $20,000, you're eligible for $30,000 in need-based financial aid at that institution. Same family, $20,000 cost at a $20,000 EFC, you're eligible for $0 in need-based aid at that institution. right? So that's just fundamentally how they work it. So just because you qualify for $30,000 of need does not mean they have it. Most schools aren't able to be that generous with need-based financial aid. Some meet 100%. Those are high-end privates with huge endowments. Others meet 50%. So just because you qualify doesn't mean that they have it. So understand that that's how that fits. This is a big one on the chopping block. It sounds like we have some pretty well-informed people. But right now, when you have multiple kids in school, they actually give you a discount. So it's an expected family contribution. So 20,000 turns into 10,000 each if you have 2 kids in school. So the proposed change with the student aid index replacing the EFC, basically what they're saying is that this is just proposed changes that SAI, there is no split. They're saying if it's 20,000, you each can owe 20,000. So instead of us owing 10,000 for each kid, we now owe 20,000 for each kid. So 40,000 opposed to 20,000. It's a pretty major change that's proposed. So much to the fact that my co-founder, Matt Carpenter, has a petition with around 60,000 signatures on it to say that this really isn't fair. They don't know what's going on. So there's a lot of changes. We're going to be doing a bunch of webinars throughout next year on the changes, what it means. Just be aware that they're coming. And if you have people going off to school this fall, understand it could impact them because most of it all kicks in 24, 25. We do have the simplified form will go into effect even in the fall of 23 or 22 rather. But understand, come 2023, major changes coming for the 24-25 class. So there's never a lack of things to talk about with college planning. So, but the blocking and tackling of this is here. It's not a one size fits all. Different schools are going to look at you differently, figure out what you can afford. So that's need-based financial aid. And then the real thing, how do we find the schools the most generous with financial aid? They're going to look at the academics to determine your eligibility for scholarships. They're going to look at your financials to figure out, are you eligible for need-based financial aid? What you can't change is the financial aid policy of that institution. You can't change that. Okay, so I'm going to pop back out and show you what I mean in real time. So this is the College Aid Pro system. And we have every school, we have 3,500 schools in the country. We have every scholarship for every school in the country. We're going to give you a predictive outcome of what your out-of-pocket will be at each school. So when we look at these schools, if I came in here, we've got a number of great schools in here. But if I looked at a school like Dayton, if I want to look at a school like Dayton, we're going to understand what it takes to get in. The financial aid policy that they use, they're a FAFSA school. They cost 65 grand. They do pretty good with need-based financial aid. But we know also that they have 27% of kids, they get non-need merit scholarship money. So that's an important piece because we're going to project and say, actually, on an automatic basis, you get a $25,000 per year discount, $100,000 over 4 years. Traditional financial planning software doesn't do that. We're also going to help you understand what are you going to make if you go to the school. So we have major specific outcomes based on income on a 1, 5, and 10-year basis. And that's really what we're really trying to bridge that gap. So at Dayton, like here's the kind of school, here's the outcome you're going to get. An affordability profile. Here's how we break this down. We're cautioning this family because they're going to take out more loans to go here than they're going to make their first year out. So we're going to say it's good if you can stay below that first year salary. If you can just take out federal direct loans, that's pretty good outcome as well. Ideally, you have no loans, right? So the business model of school, understanding the outcomes of the school, that's really what the software is built on. Because if I go and say that was great for a scholarship, but what about Harvard? How do they do their business? Well, they use the institutional method. They cost $84,000, and they meet 100% of need. So if you're a need-based aid, great. But if you're not, they have no merit scholarships, and that's true of all the Ivies. So that's an important thing to know. You don't want a kid with an acceptance letter to Harvard or Columbia saying, and then you tell them you can't go. You need to have that conversation with their sophomore or junior in high school, and so that they can understand, right? So it's all about what the out-of-pocket cost is, though, for our family. So when we're going shopping for schools, what are we looking for? Because I'm just going to show you sorted by cost of attendance here, right? This is what our traditional financial planning software shows us, is the cost of attendance to go to that university, right? But what are we more concerned with? I'm more concerned with what my net cost is. That list flip-flopped, right? So now we're saying, how am I going to get financial aid here? What's going on at these different schools? How does this work? And now you can show people on, here's the schools that you put into the system, right? And here's what we're going to look at. Here's the net cost. Here's what it costs. Here's what they think you can afford. Here's your need-based financial aid. So you're telling me for this family, Harvard is actually the most affordable option? Probably. You're telling me that Penn State's going to cost a lot more, significantly more to go there? Yep, we are. So how do we know that though? We know that because when you look at these EFCs, these schools, and where's the merit scholarship coming from? Well, look, this is a student at this school that gets a scholarship. Over here, your best opportunity is going to be need-based grants. Ultimately, it just drives down to what is the net cost. So somebody brought up a school like Northwestern. So Northwestern right here, it costs $86,000. They think you can afford $69,000. Why is that? Well, I can show you because they are gonna look at your home equity. This family has a big chunk of home equity. They're going to assess that at 100%. Whereas these schools up here, Harvard, Stanford, they don't look at it at all. They've said we're not going to count home equity anymore. So imagine that you've got a high home equity family. Now you've got a software solution that can tell you that, look, it's nothing against you, but I don't think we're sacrificing quality to go to Stanford and Harvard over Northwestern because they think you can afford $35,000 less per year just because of your home equity. It's just their business model. I say it's nothing against you, right? It's getting down to how do we get down to these outcomes? So, and then the other powerful part of College Aid Pro, we know people know the schools are interested in, but we've created an environment where you can shop for schools like you shop for an airline ticket on Orbitz. So imagine you can go and tell a family, hey, let's just go show schools within a day's drive of the house. Can you just show me like mid-sized schools? There's a 4-year institution. I want to make sure they have my engineering degree. I kind of like to make sure that they're like ranked schools so that they're not just a slouch, and also I want to make sure that they're I'm not going to get over my head with student loans. Can you shrink that list? Yes. How would you like to sort them? Show me the ones that give me the most merit scholarship. And here's a list of schools that you would likely get the most merit scholarship within a day's drive of your house. And then can you just show me schools that are going to give me automatic scholarships? Here's 10 schools within a day's drive that have your major and meet all your criteria. They're going to give you a great automatic merit scholarship. Can you sort them by, what's on my 4-year estimated net cost? So however you want to slice and dice this, the more granular you want to get, and then you can add those schools to the list if they fit. So again, it gets down into when we're looking at these schools on a side-by-side basis, I want to help understand for a family, bringing this all together. It's not about 1 year, it's about 4 years, right? So we put the information in, we put in the facts in the budget. Now we know our budget's the same across the board, but our net cost is wildly different across the board, and our funding gap is different across the board. But now on a real-time basis, and say, look, if you go to this school, I'm a proud Penn State grad, but I'm going to look at this and go, 215, budget 101. We've got a gap of 150. Well, I'm going to have a $1,200 a month payment. I don't know that that's a great outcome. When I can go to a school up here and have either have a surplus or have very little loans. And where the rubber hits the road is understanding the outcome. So now you have a software solution that's going to automate this. You put the right information in. College Aid Pro does the rest. And you're just saying, just show me the outcomes of these schools. Is it really worth the premium to go to one school over another? I don't really think so. Boston College, sorry, I'm not sacrificing quality to go to Stanford, right? Just because of the way you think I can pay for school, I'm actually going to make more, a similar income. So these are the kind of things we get down into and really help understand where the rubber hits the road for these schools is the key. So I'm looking at Northwestern, I'm going, gosh, what about, is this a tenable school? I don't know. And maybe that doesn't work for us. And we say, like, what about a school like Harvard? I don't think that's a bad outcome, versus Northwestern with huge amounts of student loans. Here's your take home pay. Here's your payment. The math just doesn't work. So again, it's getting down into, you find these schools based on how generous they are with financial aid, merit basis versus need. And I'm trying to wrap up so I can get some Q&A. And at the end of the day, we're looking at these outcomes for students. And the last piece that I'll hit on is when you're giving great advice is that if you have these schools side by side, you've got a tool to be able to show them side by side. You can now analyze and potentially appeal for more dollars. So this is a powerful piece coming up here in the spring. We've got a January webinar planned for this. How do you analyze and appeal financial aid? This is a great student that wanted to go to Case Western, but we also had great offers from other schools. So we were able to go back to Case Western and say, you're our number one choice, but you only gave us 20,000. These other schools gave us 25. What'd they say? Can you show us the award letter? Sure. Okay. 72 hours later, they magically came up with $5,000 per year, 20,000 over 4. We essentially just bought that kid a car by asking for more dollars. So again, with our tools that we have, we showed you the advisor workstation. There's also the family portal. You can invite clients to do this on their own. You can be as involved as you want. But for us, it's, if you can help navigate this 5-part process, you can help families get to and through the maze. And I got to tell you, when you look at what you deliver inside of the platform, and you're giving people a ton of deliverables and reports and showing them the finish line, I didn't know a service like this existed. And we have advisors charging anywhere from $500 to $1,500 an hour to do this work. $500 to $1,500 an hour to go through and create your College Aid Pro reports. So hopefully that's been helpful to empower you through financial aid, but also how we've hopefully broken through to give people a great solution for an advisor and for families, and to end that student debt crisis. That's what it's all about, getting down to that finish line, helping people understand they have choices. We can shop smart. We can use our advanced search tool to do so. We can find great schools. There is an affordable path to college for every family out there. But as advisors, if we can raise the bar in advice. So I started with the 3 things. If you want to get on board, we have a 15% discount offer through Saving for College in our partnership. And again, we're also offering a free strategy session with our solutions team. We typically charge $300 for that. We're going to give away 10 of those for free. You'll be getting some follow-up. I know we're at the top of the hour. I'm going to stick around and do some Q&A, but if you got to jump, we're going to get the recording out. But again, there'll be an offer for 15% off, as well as a free hour strategy session with our team. And we appreciate the opportunity of saving for college. The best way to pay for college is to save for it, but most families, we've got to go a step beyond. We've got to understand financial aid. We've got to make sure our families aren't getting in over their heads with student loans. So I appreciate everybody's time. I'm going to close with that if you got to go, but I'm going to stick around and do Q&A. So I feel like that's sometimes where the best stuff comes out. So let me hit the Q&A here. Question from Ryan: are there 529 products out there that are fee-based instead of commission-based, or is all through a share? We don't do any commission work. So all of ours, we actually don't manage 529s either. So that's all just accounts that we manage for retirement and non-retirement. So I typically direct people towards the direct plan. I happen to live in Ohio, which is a great direct plan. So that's what we've done. We don't, I really advocate for the plans for our families. So state specific, but there's some great plans out there, which we're going to do some joint sessions with Saving for College on the 529 and how that fits. So it's a great question, though. For the 5.64 assessment on parents, if they are a married couple, is this double? So essentially 12? No. So they tally up everything in the parents' names collectively, and then that's the number. 100,000. If they've got that in joint accounts and everything, that's 5.64. They'd say, we want $5,640 towards college next year. So that's how that works. It's a collective. Can you touch on the new rules? Can you touch on the new rules regarding 529 plans owned by grandparents and how distributions now impact aid? John, this is a very informed question. Huge opportunities. So I would like to give a quick answer and then know that there's a lot of planning opportunities being created. So essentially the issue with 529 distributions right now that come from a grandparent plan that come into the school, they show up as non-reported, and then they assess them as untaxed income. The untaxed income to the student. Untaxed income to the student is assessed at 50%. So if a grandparent right now sends $529 to the institution, they're going to say that's $5,000 we're going to ding you next year, reduce your financial aid. So that's been something to navigate around. There's ways around it, obviously, today, which is wait until the latter parts of school, wait till the junior, senior year, because we've already reported income because of the prior tax year. So that's one way around it now. Going forward, so there's other strategies. You could potentially transfer the ownership to the parent. Going forward with 529s, they have basically the new rules are saying that they're not just grandparent, but any outside 529 money is not going to ding you for financial aid. So the opportunities are there, and we're going to spend quite a bit of time on that next year, is accumulating money in the grandparents' name and having that pay for college. It's kind of the best of both worlds if you trust your grandparents. So that's our understanding so far. We're going to be digging in even more. So hopefully that's helpful, John. See, grandparent opens five, I'm assuming 529 for child. It is controlled by grandparent. Is this still counted under child's assets? 529s, whoever owns it, that's who owns it. The owner can change the beneficiary at any time. So it's never 529s that really aren't a child's asset. So if grandparent owns it, it's the grandparents. It wouldn't show up as an asset on the financial aid forms. If the parent owns it, it is an asset of the parent. So again, opportunities coming. You're welcome. I saw some thank yous come through. I see some people sticking around, so I'll try and hit on a few more questions. I got about 5 more minutes. Let's see, Roth IRA. So I'll make sure I'm trying to get back through the chat, guys. So hopefully we hit some of these, Russell, on the 529. It's a parent asset. It's not a student asset. It's one of the biggest mistakes we see, most common. Can really blow people up. If you got 100,000 sitting there in 529s, and you report that as a student asset, they're going to say we want 20% of that, $20,000 next year. Whereas a parent asset, they're going to say we want 5%. So that's a huge swing in EFC just by not putting it in the right bucket. We talked a little bit on the grandparent 529. Hopefully that helped answer some of those. Roth IRA does not count as an asset, but when you withdraw to pay tuition, it would count as kids' income. As a question, yes, or the income still for the payer, like parent, uncle, or grandparent. So Roth IRA is on the tax return. So they're going to look at what was distributed. So the Roth IRA, it's a very nuanced question. So people say, oh, you can put money in the Roth IRA. It's a great tool for saving for college, and it doesn't show up as an asset, which is accurate, and that's great. But if you do take it, take the distribution, it all shows up on the tax return. It's not taxable. Typically you're going to return the principal. You may owe some taxes. There's no taxes. There's no penalty, even if you take out distributions above and beyond your principal. But it will show up as income. And if it's the parent's Roth IRA, it'll show up on income on their tax return, and that could be as high as 47%. So you do want to be very careful about the distribution strategy on the Roth IRA. Again, typically utilizing those Roth IRAs in years 3 and 4 of college, once the income's already been assessed. That's not an easy way, but that's a common way we would get around that. How accurate are those results? I'm assuming you mean in our software. Our guarantee is 90 to 95% accuracy on the out-of-pocket cost. We always want to under-promise and over-deliver, but we have tens of thousands of financial aid award letters that inform that, as well as some of the top brains in the business help us get down to a data science team that's we're very confident in our projections. And the one thing I'll tell you too, how accurate are those results? I'll tell you they're 100% more accurate than those in the traditional financial planning software. 100% better. Traditional financial planning software doesn't show scholarships or need-based aid. So we're very confident in that. Does this system updated to SAI later in 2023? Does the SAI, how are we handling that? I think it's kind of the question. Everything's updated in real time. So as things happen, we're always updating our data. It's kind of the question we're getting to here. But the student aid index is going to be a big one, but none of it's official yet. We have some things taking place that are going to go live come next financial aid year. We're not there yet. So once these things actually become law and they're official, but the calculations for the student aid index are really going to be for the 24-25 school year. So we'll be applying in 23. So obviously we're on it like a hawk. The more challenging part, to be honest, is not the SAI. It's not the federal formula. That's actually fairly easy. It's a formula. The challenge is kids that are already in school. That's number one. If we have this overlap in kids, my expectation was I was going to get more financial aid when I had overlap. You're telling me I'm not. That's one big challenge. And the other is, what about schools that don't use the federal method? Are they going to reflect the federal, or are they going to continue to give a discount based on siblings in school? And that, we think, actually is going to be a school by school thing, similar to home equity. So that's the level of nerds that we are, and we're looking into this because we know we've already talked to schools, the majority of them have said, we use the institutional method and we're going to continue to give that discount multiple kids. We just talked to some as early as last week that said, no, we're going to follow that federal, some in a high-end private. So we'll see. We will see. Yeah. So the question about integrations, we're actively working on a bunch of integrations. We understand. I'm a firm owner. I'm a financial planner. I have a pretty good feel, and I absolutely agree. The more we can reduce our inputs, the better. So stay tuned. It's a big focus of ours in the first half of next year. You're going to see a lot of integrations with CRM programs as well as financial planning applications. I'd say, Chris, just reach out to the team, info@CollegeAidPro. That goes to our team. If you have something you want to talk about or some things we can add value in your practice, we're always happy to talk about it. So supporting you with client work, client cases, whatever that may be. Workarounds. I appreciate the link there. Workarounds for grandparent 529. That's very helpful, Mark. So our the subscription for College Aid Pro, it's $99 a month as retail, and it's 15% discount. And Mark, if you can throw that discount in the chat, that would be great, and we will get that out in an email with the recording and everything. So, and if you want to talk to somebody, you can go to our advisor website and talk to one of our solutions expert as well. So happy to do demos to learn more as well. So we'll have that in the follow-up too. If you want to talk to somebody, make sure you're getting the solutions you want. We do have a bunch of solutions. I focused on the advisor workstation for today. Do you have the school list, a filter of those need blind, need aware? I don't know that we have a specific filter for the need blind, need aware. We don't have that in the system right now. It's something I actually could be valuable. Never actually really thought about it that much to make a filter, but we can, if we have the data, we can filter it. Oftentimes, to be honest, though, the schools are dishonest. They say they're need blind and they're not. That's the way. Let's see. So I'm gonna flip over to the Q&A. I think I hit everybody in chat. Ted's asking, I have an incoming college freshman. When looking at offers, how stable is the projection throughout the ensuing 4 years? Can they make the first year look better and the other shoe drops down the road? Yeah, so very important. Understand the 4-year cost. Understand about what are we getting into. We've often said with the overlap, it actually creates an opportunity, especially at our high-end privates, to meet 100% of need. But we're actually in the process now. If people are accepting these offers, we're actually going back to the school to say, our understanding is when we have, so let's say we've got a senior and a junior right now. If I have a senior going off to school, my EFC is $80,000. And I know that the years 2, 3, and 4, there's going to be overlap. I'm absolutely calling that institution to say, look, what's going to happen if we send our second student here? And that's how I would phrase that. We're both got into your elite institution, your $80,000 a year. We'd also like their younger brother to go to school here. So if we do that, is there a discount for that? Because that's what we understood through the formulas. I'm looking directly at the school because they're not all looking at it the same way. So I would try and get those assurances. So hopefully that's helpful. I would go directly to that school if you've got a incoming college freshman. What are we looking at here? And scholarships are a lot better than need-based financial aid. That's the other thing. Scholarships are typically renewable as long as you keep your grades up. They don't take scholarships away, but they oftentimes also have teaser scholarships that are only for 1 year. So when you're analyzing a financial aid award, you want to make sure that you're aware of that, I guess I would say. So just make sure. So you always want to analyze those awards and potentially appeal. So we'll have a session in January, February on that process. So if you've got an incoming freshman, rising freshman in college, your senior graduation, you're going to be getting all the award letters here in the next 2 to 3 months, and you've got to make a decision by May 1. So what we talk about is, we want to make sure you want to compare things apples to apples and potentially get more financial aid. That's the key. So hopefully, Ted, we if we can help, let us know. Do you use custodial Roth IRAs for kids to grow their own Roths to use for funding? Ryan, that's a great question about using a Roth IRA in the student's name. So, Roth IRA, be it custodial, however we're funding them. I love Roth IRAs in children's names. Even if we don't use it for college, I mean, there's lots of reasons, right? So one of the things, but yeah, using it for funding college, particularly for our families that aren't financial aid candidates, right? So that's the other key here is when we go down this path, it's like, are you a need-based candidate or not? Because if you're not, we're going to stop worrying about it. We're going to do what's right for you based on the tax planning that we can do, putting assets in the right place, saving in the right place. Because for a lot of families, even if you go today, they're going to be like, oh, we're not need-based candidates. I say, awesome. Let's go forward. Let's go find schools that are going to give us great scholarships regardless of need. And let's go execute on our tax planning strategies that we can do. Can we gift money? Can we use Roth IRAs? Can we shift income? What type of things can we do? So hopefully, that's next level stuff. So, okay. So yeah, so I see one last question, then we'll hang it up. It's 2:15. I appreciate everybody sticking on. Hopefully these Q&As are helpful. Some parents say they did not ask for financial aid since they don't want to impact the admission possibilities for the kid, but start to apply for that once since in the second year. However, some school announced that if no financial aid application for the first year, no for the rest of the 3 years. Have you heard about that? Yeah, so people holding back their financial information and financial aid applications saying, oh, we don't want any financial aid in year one. If you do that, the majority of schools say, if you didn't ask for it year one, you're not getting it in years 2, 3, or 4. Period. That's most schools, especially those with significant endowments. If you didn't want it year one and you were holding it back because you thought it gave you a better chance to get in, we're assuming you don't want money at all. And that's just, if I'm a school, that's how I would handle it too. Things change, circumstances change. That's why I say for 99% of people, you're going to submit those forms. If you're trying to play that game from an admissions standpoint, it's a little different. From a financial standpoint, you're going to want to submit those forms. So there's two different things at play. There's always admissions, and then there's the financials. So it is not a one size fits all. That same family may approach different schools in a different way. So you choose who you provide that information to on the financial aid forms. So, but in the times that we're in with all the COVID stuff and people losing jobs and people, quite frankly, passing away, you can absolutely go back and say, hey, look, like I know we didn't apply, but our circumstances have changed. Why we didn't apply, that's dramatically different. So, we have a different life circumstance now. So that's the financial aid offices at most universities. They really do want to make sure that families get the money that they deserve. They just don't want to get cheated. So they have their guard up. But if you have a legitimate way and you can say, hey, look, we were out of work for 6 months, that they absolutely are going to help as much as they can. So in my experience. So, all right, awesome. Hey, we'll be in touch with follow-up and the recording and some slides. So hopefully this has all been helpful for everybody. And we look forward to continuing partnership with Saving for College. And we'll see you all hopefully in the new year. And please reach out, visit us at collegeaidpro.com/advisor if you have questions, and hopefully we'll have a chance to talk soon. Thanks.